Know the difference with Annex Wealth Management? What is the 4% rule? Some retiree portfolios withdraw 4% of assets in the first year and then adjust for inflation thereafter. But is it offering the same reliability that it once did? Given today's changing market conditions, might mean retirees and their advisors might need to reassess on how much they can safely be withdrawing. So to help make sense on what a withdrawal future might look like for you, certified financial planner and financial planning specialist at Annex Wealth Management, Corey Borchard joins us. Hi, Corey.
Hey, Joe. Thanks for having me.
First, what exactly is the 4% rule and why has it been so popular with retirees and planners in the past?
Yeah, Joe, it's essentially a guideline that states if you're withdrawing 4% of your portfolio per year, that's generally going to ensure that your portfolio lasts through your entire retirement. Now, of course, it's popular because it's very simple, straightforward, easy to remember, but we'd say it's more of a guideline and a starting point because, of course, it can be more complicated than that.
And what are some of the reasons that it might no longer be reliable today?
Well, first of all, these guidelines were created based on historical data, and as we know, the sequence of returns can play a big role on how your portfolio performs. Retiree lifespans are changing, so you may need to extend your portfolio longer. Not only that, but some people might retire earlier, which means you're going to have a longer window in which you're going to need to spend your money. I know I'd like to retire early. How about you, Joe?
Yeah, I want to retire early. I also want to live longer, too. So we were talking about that on previous radio segments, too, where people are retiring at 65. They could live till, let's say, 85 or 95. So you need to plan a little bit longer and maybe adjust that 4% strategy.
Yeah, adjustment is the key word. You're going to have to be prepared to make those adjustments. And then I would add to that, not everybody's lifestyles are the same. Some people spend more, some people spend less. So it's important to dial those things in and be prepared for unexpected expenses. So 4% might not always be constant.
And with clients at Annex, how are you kind of translating this as an adjustment for some people's portfolios?
Yeah, exactly. We're going to want to look at the full financial picture. So look at your other income sources, your pension, Social Security. What is your investment risk? What's your risk tolerance, spending goals? It's not just what is my safe number to withdraw. We do a lot of analysis on things like when should I start my Social Security? When should I start my pension? Would my plan benefit from something like an annuity or long-term care insurance? So we want to make sure that we're stressing the plan, revisiting it on a regular basis, not just set it and forget it, because these things change over time. So it's important to look at that.
And do you go in talking about the 4% plan before they retire, or is this something you're looking at after they retire?
Oh, you definitely want to be looking at before and after, because before you arrive at your destination, you have to do some planning on how to get there, right? Take into account many other factors. I think the first thing to say is we talk about 4%, but then we have to say, where is that money coming from? You have your checking accounts, IRAs, Roth IRAs, annuities. You have so many different tax status accounts. It's important how you take it out, not just the amount you're taking out too.
If you're taking the 4% out, what are some strategies you recommend to Annex clients to help retirees make their portfolio last a little bit longer with things that are changing all the time?
Yeah, you're going to want to diversify your investments a bit, maybe tilt some of your asset classes, maybe focus on some growth. There might be also strategies where you want to look at things that are more conservative, bond ladders, inflation-protected securities, or annuities. Build some sort of stable income if you're concerned about running out of money. Many retirees are facing things like a long-term care event. You don't know when that's going to happen, but it's good to have a plan. When it does happen, you know where that money's going to come from. And it's going to be a lot more than 4% probably.
If somebody's retiring soon or they're already retired, what is the connection between their asset allocation? We talk a lot about asset allocation on this show and also their withdrawal rate.
Yeah, that withdrawal rate is heavily going to depend on how that money's invested. So if you're a little more growth oriented, well, then you might have more power potential there, but then also more risk with those assets. And then if you're going to lean into a more of a conservative allocation, well, because you don't have as much growth potential, you may have to take a little bit less. And then there's also consideration whether you prefer those withdrawals to be more probability-based. So if you're invested in the stock market, bonds, things like that, that's more of a probability-based approach. There's also the philosophy of a safety-based approach where maybe you take something like an annuity or insurance and then you're transferring some of that risk. So we call that a safety-based approach.
And you're thinking about, I get to withdraw 4%, or I want to be able to enjoy my retirement. So if you're focused on that, you still want the remaining money to grow.
Yeah, that's a really good point. There's different buckets of money there you have. Some are going to be allocated where you're going to have more flexible spending, focus on the growth, whereas maybe more conservative, maybe you have short-term allocations, things that you're planning for that you want to reliably have that money for. That's going to look a lot different for that. But again, like you said, the 4% rule, it's a general rule, but you want to make sure it's a starting point. It's not one size fits all.
Let's say you are sticking to that 4% rule and your other money is growing. Do you tend to go a little bit more aggressive on the money that's remaining?
Yeah, if you are creating stable sources of income in one area, you know that money is more reliably going to be there. That might change your mindset towards how the rest of your money is invested because you're like, okay, that's my money that I compartmentalize for spending. This is my fun money to do things with.
With fun money, we like it.
I like fun money.
Good stuff as always. Corey Borchert, financial planning specialist, Annex Wealth Management, certified financial planner. Thanks for joining us, Corey.
Yeah, appreciate it, Joe. Thank you.
Go to annexwealth.com.